In this issue of Crushing Capitalism, we discuss the Bernanke Bubble. Bernanke has been trying to inflate his way out of the Depression. He's been doing this by the QE1 and QE2 programs, the quantitative easing, which is just another fancy way of saying printing money. He's also been trying to inflate the economy by giving the largest corporations, both American and foreign, in essence, zero-interest loans. Now, all of this is targeted toward the housing collapse, which it resulted into a collapse of consumption. However, as has been argued in other issues of Crushing Capitalism, the real problem is not that we have insufficient consumption. The real problem is that we have insufficient employment and woefully insufficient wages for the bottom 80% of the US population. So by printing money, Bernanke is not only trying to inflate his way out of a housing market disaster, but he is also trying to help the stock market. Specifically, the stock market has no buyers. It's been a long time now that the individual investor has stayed away from the stock market, ever since the collapse of 2008, which leaves only institutional investors. But here we have a weird cycle of purchasing in the stock market. On the one hand, all that extra money that Bernanke is printing is finding its way somehow into the stock market. Why? Because by keeping interest rates at near zero, Bernanke is forcing investors to put their money not into conventional investments that would have a high yield and also would be secure, but rather into the stock market because everything else now is yielding zero interest. In other words, they are chasing dividends. This is pushing the price of stocks up, but it's inflationary. It's not reflecting the real value of corporations having gone up and therefore justifying an increase in the share price of the corporation. Instead, as I said, these are extra dollars flooding the stock market. Sadly, these extra dollars are not, as I mentioned earlier, individual investor dollars. Those guys are broke. These are institutional investors. Who are these institutional investors? Major pension plans, other government plans, but primarily corporations themselves. So now we also are seeing corporations being the primary players in purchasing stock in the stock market. In essence, they are purchasing themselves, but they're also purchasing other corporations. But if there are no individual investors in any significant number investing in the stock market, and all these corporations are the ones doing the transactions, one has to wonder, how public is the public stock market when the only real investors are institutional and in essence wind up owning themselves, and they are private corporations by that definition? And the other issue that is raised, which is of primary significance to us as regular folk, what's going to happen when Bernanke stops printing money? What's going to happen when they finally realize the individual consumer is never going to come back because his wages went to China? What's going to happen when we finally hit the deflationary period of this stock market? Then we're going to see some very interesting times indeed. And mark my word, they're not that far away. In global solidarity, Dr. Asimakopoulos.